hey, the market is rallying 65%. That means the economy is getting better, right? And the answer is no. That means you don't understand your market history. If you go back and look at secular bear markets, they very much look very similar. They're not identical. It's not anything you can basically say, hey, here's the roadmap for exactly what's going to happen, but they certainly rhyme. And what we've seen over time is that in a secular bear market, and I'm going to pull it up on my screen as we speak, in a secular bear market, we see a pretty substantial sell-off rally and trading range that is fairly consistent over time.
Let's tie all of this into commodities. Going back to commodities, so you talked about gold. You think gold's going to continue? I don't know if you want to finish your thought on that, because I also want to talk about
sure.
oil.
And when I say secular bear market, I don't mean stocks. I mean oil, dollars, gold, copper, equities, Japan, Spain, housing, across the board. I mean housing,
right.
Home builder stocks. All of these secular bear markets you can take, and I have a friend in Morgan Stanley Europe who actually did this. I'll send you the chart for this. And you literally can look at these bear markets, and they have just a tremendous similarity. On average, they'll fall about 56% over the course of 29 months. Hey, that's pretty much where we peaked to trough, collapse. We were over 53% on the S&P and the Dow. Then you get a rebound rally that tends to go about 70% and tends to last about 17 months. And what are we up now? About 60% from the bottom. So on average, we're in the eighth inning. If this was because this was a faster sell-off, maybe the rally is going to be bigger. But that's just the S&P. That's not talking oil, gold, or bonds. Then you tend to have a correction that lasts about a year and about 25%. And then over the next 5 years, you enter a wide trading range. So in terms of equities, this has clearly been a secular bear market. In terms of oil, it's been a classic secular bear market. 145 down to 30, up to 80. Gold
where does it go
minor.
From here? Where does oil go from here? Where do you, the reason we love having you is because we're not looking at the markets to be the discounter. I think a lot of people want to hear from you. So what does this do for all this in the big picture, which is name your blog, by the way? What does this do for oil?
Well, there's three factors that are, everything is in threes. There are three factors that are driving oil. One is demand worldwide, and the decrease in demand in the U.S. And the decrease in demand in Europe is offset by the increase in demand from China and the rest of the world's emerging markets. Right now, that's fairly much in stasis. If there's the slightest bit of improvement in the economy in the U.S. or Europe, you could see oil zip right back up to $100, $120 very, very easily. Right now, we have a modest sort of balance. There's been a balance between the output from the Middle East, the decrease in the U.S. and Europe, and the increase overseas. So it won't take much improvement in the economy to send oil higher. Secondly, obviously, in nominal terms, everything that's priced in dollars, as the Fed's printing press are working 24/7, the dollar is getting a little smaller every day. Oil prices are just going to go the other direction, as will any commodity that's priced in oil. There's just no other way around it. If you are going to print your way out of debt by debasing your currency, all the things that are measured in dollars are going to cost more. So that's copper and gold and aluminum and steel and of course, oil. So the weaker the dollar gets, the higher in nominal terms. It's not real, it's nominal. In real terms, the dollar's a little smaller, oil's a little bigger, but it's the same exact thing in real terms. But in nominal terms, if you live and die in a pure dollar environment, it seems that these things are going higher.
And that's what I want to ask you about. So is this a different environment for American investors? So you manage a lot of money for high net worth clients. So you're basically saying even if they were to put their money into gold and commodities, at the end of the day, it's going to net out that they'll probably remain flat. But what if you're Canadian? What if you're in Europe or another country?
I just came back from Europe, and the thought process there seems to be we'd much rather be in emerging markets and commodities than buying U.S. equities or treasuries for that matter, because whatever the gains are on the equity side, the losses in the currency side are going to offset it. So to them, it's a flat trade. It's not, gee, equities are going up, isn't everything great? If you're in the U.S., hey, it looks great. You buy the stuff, it goes up, it's terrific. You're just in for real ugly surprise when you go overseas and discover that you have a pocket full of pesos, that the dollar is no longer the almighty greenback. It's, a third world currency that has decreasing value. In Berlin, I got it took $1.59 to buy a euro. That's unconscionable. That's just unbelievable.
What are you telling your high net worth clients to do? Are they buying gold? Are you getting them to gold in baskets of commodities? What are you recommending?
Well,
for
the main way we manage assets for high net worth individuals and family offices and actually institutions is through our asset allocation model, which essentially looks at three factors. The short version is called fundamental, technical, and macro, but what that means in English is we look at valuation. That's what matters most in terms of fundamentals. We look at trend and momentum. That's the most significant factor in the technicals. And then in the macro side, the economic side, we care about interest rates, tax policy, and what's going on with money supply. So we look at 70 different asset classes. We typically hold about 20 at any given time. It's primarily done through ETFs, which you can now find an ETF for just about any asset class, including things like fixed income arbitrage, convertible ARBs, emerging markets, big cap growth, small cap value. Down the list, there's an ETF that works for that. There's one or two things that you, like we found a fund that actually apes the returns of private equity. So we even have private equity as an asset class, and we typically rebalance every quarter. We typically hold these things for about 2 years, although every now and then there's a classic example. So we had a position in municipal bonds in the U.S., but with the more the Fed says they're going to keep rates really low, the higher the muni bonds ran up and the lower their yield went, to the point where, who the hell wants to buy muni bonds that are paying almost no interest rate? So on a valuation basis, we ended up rotating out of that, rotating half into cash and half into emerging market equity. The thought process is that's a bet on both the growth of various countries, and that includes places like Brazil and South Korea and Malaysia and stuff like that, as well as it's really a bet on the dollar also. When the dollar is weak, those things will do well, relatively speaking.
We're inside of a couple of minutes, so I'm going to ask you a couple of questions. Maybe we can
Sure.
do a bit of a rapid fire. Whenever I hear about in U.S. investors looking outside of America for investments, how come they don't talk about Canada?
I have no idea. I mean, David Rosenberg up at Gluskin Sheff is a friend of mine, and he used to be at Merrill, and he's from Canada, and he calls it rocks and trees, which is essentially minerals and timber. Canada, I remember back when the 60 cents bought a loonie, their currency now is almost parity now. It's incredible how strong their currency is relative to the U.S. I think because Canada is relatively tied to the U.S. economy, people don't think of it as diversifying. But as you've seen over the past year or two, Canada has held up much better than the U.S. did. Their financial sector did well. Everybody seems to think most of the U.S. oil comes from the Middle East. That's not true. The biggest trading partner the United States has, in terms of crude oil, is Canada. They're the single biggest supplier to the United States from outside. So you can think of Canada as a non-domestic, not necessarily correlated economy to the U.S. They've done well, and it's certainly worth thinking about. I have been to Canada repeatedly over the past couple of years, and it's a very different environment for business. It's a very different economy because it reminds me to some degree of Australia. Located near a superpower, huge natural resources, lots of timber, lots of minerals, lots of oil, obviously plenty of gold mines and things along those lines. Canada is a great way to garner exposure to commodities if that's what you're looking for your portfolio.
U.S. dollar, where are we, I don't know if this is a fair question, but you tell, where are we a year from now or 6 months from now or whatever period you're most comfortable with? Where do we go?
I'll give you a few of them. From 2001 to 2008, the U.S. dollar lost 41% of its value. Then during the collapse, everybody flocked to the dollar as a safe haven, which is part of the reason why we saw a nice pullback in gold. I remember about a year and a half ago, you and I were talking about, hey, a pullback in gold is due, and that's when you back up the truck.